On January 1st, 2026, China did something unprecedented. They classified silver as a strategic resource and locked down exports. Only 44 companies in the entire country were approved to ship silver outside Chinese borders. 44. Out of thousands. Beijing was telling the world in the clearest possible terms, silver is ours now. The market heard that message loud and clear. Prices surged. Analysts called it the beginning of a structural repricing. Investors piled in. And for 4 straight weeks, it was Chinese money, Chinese speculators, Chinese equity funds, Chinese retail traders. Driving silver to heights nobody thought possible. $100. Then $110. Then, on Thursday, January 29th, silver touched $121 an ounce, an all-time record that made the Hunt brothers look like amateurs. And then, in the space of a single trading session, those same Chinese investors destroyed it. Friday, January 30th, silver crashed 30%, the worst single day since March 1980, $40 billion traded through the iShares Silver Trust alone. Not in a week, not in a month, in one day. Gold dropped 9%, copper unwound an 11% rally in hours. A veteran trader at Heraeus Precious Metals, one of the world's largest bullion refiners, said it was the wildest thing he'd ever seen in his career. And his exact framing tells you everything. Gold is a symbol of stability, but such a move is not a symbol of stability. The headlines blamed Trump's nomination of Kevin Warsh as Fed chair. And yes, that was the match. But the gasoline? That was poured by the same hands that lit the fire in the first place. China built this rally. China crashed this rally. And if you think that's a coincidence, you haven't been paying attention to how Beijing operates. This isn't a story about a market correction. This is a story about the largest single-day wealth transfer in silver history. And the $40 billion question nobody on Wall Street is willing to ask out loud. To understand what really happened, we need to go back 4 weeks to early January, when the Asian trading session became the most dangerous 3 hours in global finance. For years, the silver rally was driven by fundamentals, supply deficits, industrial demand from solar panels and semiconductors, central bank gold buying pushing investors into the white metal as an alternative. These were real forces, and they pushed silver from $30 to $60 and then past $80 by the end of 2025. Respectable gains, sustainable momentum, a story that made sense. Then January 2026 happened, and everything detached from reason. It started in Shanghai. Chinese retail investors, millions of them, began pouring money into commodity futures. Not just silver, gold, copper, tin. Everything was moving. But silver was the magnet. It was small enough to squeeze, volatile enough to generate massive returns, and suddenly blessed with the ultimate narrative. China had just restricted exports, which meant supply was about to evaporate. The trade was obvious, too obvious. Within days, the buying spread from retail accounts to institutional money. Large Chinese equity funds that had never touched a commodity contract suddenly started taking massive positions in silver futures. Bloomberg reported that trend-following commodity trading advisors piled in on top of the Chinese flow, adding what one analyst called more froth to the rally. Jay Hatfield, chief investment officer at hedge fund Infrastructure Capital Advisors, was watching it unfold in real time. He identified the shift weeks before the crash. His assessment was blunt. This had become a momentum trade, not a fundamental trade. The underlying supply story was real, but the price action had completely detached from it. And here's where it gets surreal. Every single night, European and American traders would go to sleep with silver at one price and wake up to find it $5, $10, sometimes $15 higher. The Asian session was a one-way escalator. Bleary-eyed London traders watched in astonishment as prices gapped up before their morning coffee. The pattern was so consistent, it felt engineered. Buy in Asia, hold through London, let New York chase. Rinse and repeat. If you're finding this valuable, if this is changing how you understand what happened last week, hit the like button. Because the next section takes this much deeper, and getting this kind of analysis in front of more eyes genuinely matters. All right, here's where the final frenzy began. On Tuesday night, January 28th, Trump made an offhand comment that the US dollar was doing great. That was the last spark. The Asian session that followed was pure mania. By Thursday morning, gold had hit $55.95 an ounce. Silver topped 121. Copper reached an all-time high at 14,500. These weren't gradual moves. These were vertical. And everyone riding the momentum knew, even if they wouldn't admit it, that vertical markets don't stay vertical forever. What nobody anticipated was how fast the reversal would come and who would pull the trigger first. The first crack appeared Thursday afternoon in New York. The dollar started climbing as U.S. markets opened, and gold suddenly dropped $200 an ounce in roughly 10 minutes. Not a gradual sell-off, a cliff. Prices stabilized briefly, just long enough for traders to convince themselves it was a normal pullback in a raging bull market. Then Bloomberg reported that Trump was nominating Kevin Warsh as the next Federal Reserve chair. Warsh is a former Fed governor, a Morgan Stanley veteran, and a monetary hawk who dissented against quantitative easing back in 2010. The market read his nomination as the end of easy money, a signal that the Fed would not keep cutting rates or expanding its balance sheet. The dollar surged, and in the Asian session that followed, the same session that had been reliably pushing silver higher for 4 straight weeks, Chinese investors did the opposite. They sold, not trimmed positions, not rebalanced. They dumped. One London-based trader, Daniel Campbell, summarized what happened in 5 words that will define this crash for years to come. China sold, and now we are suffering the consequences. Friday morning was pure carnage. Silver opened lower in Asia and never recovered. By the time European markets were active, it was already below $100. By midday in New York, it had cratered to $78 on the COMEX. Silver futures dropped 31.4% at settlement, the worst closing decline since March 27, 1980. Morgan Stanley's quantitative desk flagged what they called massive forced rebalancing. $3.5 billion in forced selling from leveraged silver ETFs in a single session. The statistical measure of the move was negative 13 standard deviations. For context, anything beyond 3 is considered extreme. This was in a category that technically shouldn't exist, and then, after the crash, the CME made its move. Not before, after. On Friday evening, they announced another round of margin increases. Gold margins went from 6% to 8%. Silver margins were hiked again. The timing here is critical, so stay with me. Raising margins after a 30% crash doesn't stabilize the market. It deepens the liquidation. Traders who survived Friday's selling now faced higher collateral requirements on Monday morning. Those who couldn't meet the margin calls would be forced to sell again at even lower prices. Matt Maley, equity strategist at Miller Tabak, was watching the forced selling cascade in real time. This has been the hottest asset for day traders and short-term traders, he said. There was leverage built up. With the huge decline, the margin calls went out. So here's the question everyone should be asking, but almost nobody is. If the CME's mandate is to maintain orderly markets, why did they raise margins after the biggest crash in 46 years? Who does that protect? And who does it destroy? Because the answer to that tells you everything about what happened last Friday, and everything about what's coming next. Here's what most coverage of this crash is missing entirely. There are 2 Chinas operating in the silver market right now, and they are playing completely different games. China. The government has spent the last year building a fortress around its physical silver supply. Export licenses restricted to 44 companies, a production minimum of 80 tons per year just to qualify. A 2-year licensing framework that mirrors the playbook Beijing used with rare earths: gradual restriction, strategic leverage, eventual market dominance. The United States responded by adding silver to its critical minerals list in November 2025. Elon Musk posted on X that China's restrictions were not good because silver is needed in many industrial processes. The message from Beijing was unmistakable. We control the physical metal, and we intend to keep it. China? The speculator is a completely different animal. Chinese retail traders and newly minted commodity funds don't think in 10-year supply chains or export licensing frameworks. They think in momentum, they think in leverage. And when the momentum broke on Thursday night, they did what momentum traders always do. They ran for the exit at full speed. The irony is devastating. Beijing spent a year engineering a physical silver squeeze, only to watch its own citizens crash the paper market by 40% in 12 hours. 2 Chinas, 2 opposite strategies, and the rest of the world caught in the middle. Now here's where the real revelation lives. While the paper price was in free fall, the physical market barely flinched. Shanghai physical silver premiums over COMEX remained $5 to $8 an ounce, even during the worst of the selling. The futures price said silver was worth $78. The physical market said it was worth $85. That gap, that divergence between what a paper contract says silver is worth and what actual metal costs to buy and hold, is the single most important number in this entire story. Some estimates place the paper to physical ratio at 356 to 1 before the crash. That means for every single ounce of real silver sitting in a registered vault, 356 ounces of paper silver were trading on exchanges. The crash didn't fix that ratio. It made it worse because the forced selling was all paper. The physical metal didn't move. COMEX registered inventories, already down 70% since 2020, didn't suddenly refill because futures traders got liquidated. And the companies that actually need silver, the ones building solar panels, semiconductors, electric vehicles, they aren't buying futures contracts. Samsung finalized a direct mining prepayment deal to restart a silver mine in Mexico, bypassing the exchange entirely. Tesla has been securing physical supply through direct offtake agreements. These aren't companies speculating on silver prices. These are companies that need real metal to build real products, and they've concluded that the exchange system can no longer be trusted to deliver it. I want you to think about something. If the paper market can lose 30% in a day while physical premiums hold firm, which price is real? Is the COMEX number the truth, or is it a fiction maintained by leverage, margin rules, and forced liquidation? Drop your answer in the comments. I'm genuinely curious where you land on this because I believe it's the defining question for silver in 2026. So where does this leave us? Let's be precise about what changed and what didn't. What changed? Speculative excess has been violently purged from the silver market. The leveraged tourists, the momentum chasers, the late arrivals who bought at 115 hoping for 150. They've been wiped out. That's the mechanical reality of a 30% crash followed by margin increases. The weak hands are gone. The hot money from Shanghai has evaporated, and the headlines now read like obituaries. What hasn't changed? Everything that made silver go from $30 to $120 in the first place. China's export restrictions are still in effect. Only 44 companies can ship silver out of the country, and that framework runs through 2027. Global silver demand exceeded supply for the 5th consecutive year in 2025, with a structural deficit estimated at 200 million ounces. COMEX registered inventories remain at historic lows. The solar industry's appetite for silver isn't slowing down. AI data centers, electric vehicles, semiconductor fabrication, 5th-generation telecom infrastructure. Every major technology trend of the next decade requires more silver, not less. Not a single one of those fundamentals was altered by Kevin Warsh's nomination or by Chinese speculators cashing out. There's a date that matters enormously now, and very few people are talking about it. February 27th. That's the first notice day for March COMEX silver contracts, the deadline when futures holders must declare whether they intend to take physical delivery. With inventories depleted and the paper-to-physical ratio still wildly distorted, March delivery is shaping up to be a stress test the exchange may not survive cleanly. If enough traders stand for delivery, if they demand real metal instead of cash settlement, the math doesn't work. There isn't enough registered silver in the vaults to cover it. Here's the honest picture. Nobody? Not me. Not the analysts at UBS who still see triple-digit silver. Not Bank of America, who admitted retail demand alone could push prices to 170. Nobody can tell you with certainty whether Friday's crash was the bottom or the beginning of something worse. Markets that fall 30% can fall another 30%. But there is a fundamental difference between a speculative bubble popping and a structural supply crisis being interrupted by a liquidation event. Bubbles don't come back. Supply deficits don't go away. Think back to where we started. On January 1st, China told the world that silver was a strategic asset worth protecting. For 4 weeks, Chinese speculators bid silver to all-time highs. Then, in a single session, they crashed it. The government is hoarding physical metal, the traders dumped paper contracts, and somewhere between those two forces, between the vault in Shanghai and the futures screen in Chicago, between the physical premium and the paper price, the real value of silver is being determined right now. Not by algorithms, not by margin requirements, not by a single nomination at the Federal Reserve, by the simple, brutal question of whether there is enough metal in the ground and in the vaults to feed the world's insatiable hunger for it. The answer, as of today, is no. And no crash changes that arithmetic. They built this system to keep that answer hidden. Now you see it. The question is what you do with it.